So this lecture may not even know that. Little quickie lecture about the evolution of American banking, 10 minutes or something like that. So you'll appreciate why this way of thinking is now necessary, okay? And it's not what was in the textbooks 50 years ago, okay? Or actually most of the textbooks even today, because they've just inherited. There's a sort of hysteresis of textbooks. I want, and this will help you also, I think, to understand Stigum a little bit. Stigum wrote her first, you know, she's a child of an earlier generation. I need a clean eraser here. And for her, when she talks about banks, she is not thinking like this. Okay, not at all. She couldn't possibly be thinking like this. And so I now want to give you an insight into how she's thinking so that you can sort of translate between what you're reading in that book and what you're seeing in this class. So for her generation, the understanding of the banking system was as an intermediary between households and businesses. Households and businesses. The way this is supposed to work is this, that households save in the form of bank deposits and the banks make loans to corporations on the other side here. So that short-term, you know, the banking system is a sort of Janus-faced sort of person, okay, that's looking to the household and giving them the kind of asset they want, a short-term liquid money asset, and it's giving business the kind of liability they want, a long-term source of funds in order to fund capital investment for the nation. So just say investment here. This is investment in the economist terms, meaning it's a factory or a machine or something like that, okay? Not a stock or a bond here, okay? So you're financing the capital development of the country, okay, by using the money holdings of the households. This is the classic view. Now it may also be the banks aren't just doing that, they're also holding some securities, particularly government securities. And they may also be doing some wholesale borrowing. Okay? And because of this, loans and deposits don't exactly move together, right? Because if you have more deposits than you know what to do with, then you just buy securities, okay? Or if you have more loans than you can fund with local deposits, then you just go into the wholesale market. So it creates some flexibility here. And these banks have capital, okay, to protect them against losses here, so that absorbs losses, and they have reserves, cash. Reserves at the Fed or something like that in order to make payment systems. So this is how the banking system is conceived and how it worked in a way when she started writing. This sort of wonderful life, 50s era banking system. But by the time I was starting to teach banking, which was a pretty long time ago actually, this had already was no longer the way the world was, okay? But it wasn't like that yet, okay? It changed a bit by bit, okay? And I was living through it, so I'll tell you some of the things that happened, okay? The first thing that happened, okay, was the death of loans, okay? Because corporations found out that they could tap commercial paper markets cheaper. They could get a better rate in the commercial paper market than they could get from the banking system. And so they started to go to the commercial paper market and borrow there instead. Okay. The other thing that happened was the death of deposits. Okay. And that was because of this mutual fund thing that I just mentioned to you, okay, from the reserve primary fund, which is that households discovered that they could, and businesses too, if they had deposits, that they could put their money into money market mutual funds and get paid interest. And so they left the banking system. So there started to develop this parallel banking system. So there's a parallel system in which there were, say, finance companies grew up, and money market mutual funds grew up. Okay. And these finance companies are issuing commercial paper and making loans using the proceeds that they have. So for example, General Motors, financing company, is issuing commercial paper and making auto loans even, so it's operating as a bank. Auto lending is no longer a business of a bank, it's a business of the financing arm of General Motors. And money market mutual funds are buying that commercial paper and other stuff, as an asset, and they're issuing deposit substitutes, these shares that we mentioned here. Okay, so this is the death of deposits piece, okay, and this is the death of loans piece. So the point is that all of this intermediation that used to be going through banks no longer was going through banks. It was going through these non-banks, they were called. Nobody knew what to call it. They started to talk about a parallel banking system was like growing up. The end of the story, or it's not the end, but it's the most recent part of the story, is a further evolution of this, okay, which was the development of the shadow banking system, okay? And so here's the shadow banking system is the next evolution of this, okay? In this case, it's not businesses that are borrowing, but households. And they're issuing mortgage debt, okay, in order to buy their houses, okay? This is the kind of thing that normally you would go to a savings and loan, right, and borrow from Jimmy Stewart, okay? That's the whole idea, okay? Not anymore, okay? You issue this mortgage, it gets packaged with lots of other mortgages, and I'm going to leave out all those steps, okay, and becomes a mortgage-backed security, a residential mortgage-backed security that's held by some entity that we're going to call a shadow bank. This might be an on-balance sheet entry. If it was a European bank, it might be a structured investment vehicle. If it was a Citibank operation, we're going to talk about a lot of this later on. I'm just opening the door right now. There's slicing and dicing and tranching and stuff to make this, whatever this shadow bank is buying here, AAA, okay? And that's meaning high quality stuff that it's a quasi treasury bill, okay? It's like government paper. And it's used as collateral to borrow in the wholesale money market. So there's money market funding of this mortgage lending, okay? For example, asset-backed commercial paper and repo. And who buys that? A money market mutual fund buys that asset-backed commercial paper, buys that repo, okay, and funds its position with mutual fund shares that are substitutes for deposits. Okay, so you see once again, okay, whereas before it was households holding deposits at banks that were funding loans, now it's shares that are funding mortgages, okay? But it's not passing through a bank anywhere. It's not passing through a bank that has an account at the Fed or anything like that. It's all non-bank operations. And in fact, a lot of this was happening offshore in Europe. Okay. Isn't that kind of funny? A big European bank like Union Bank of Switzerland or Deutsche Bank is borrowing in the dollar money market and using the proceeds to invest in the dollar RMBS market, okay? And they don't use dollars for anything, they're in Europe, okay? But they're doing this particular arbitrage on their own balance sheet, or in a trust or something else, okay? It's this evolution okay, that I think requires us to reconceptualize our understanding of the theory of money in banking. Okay? Because think about the shadow bank. We're gonna really do this in one of the last lectures in the class. I'm just going to hint and open the door for this now. What matters for a shadow bank? How do you make money if you're a shadow bank? What matters to you is two things. Okay? One is the price of your assets. The price of your assets. And the other is the price of your funding. Okay? When we talk about the price of your assets, we're talking about the bond market, essentially. These are bond-like entities. So we're talking about the trainer model. We have a story about where the price of bonds comes from. There's some sort of dealer model behind the scenes that's going on here. When we're talking about this price, you're talking about the term interest rate, which we now have a story of here too. So this is the point, that the modern banking system is a capital market-based credit system, not a bank loan-based system. And in a capital market-based credit system, the prices are both determined in dealer markets. The key prices are both determined in dealer markets. So we got to understand dealer markets. That's why we have the economics of the dealer function in such a central place in this course.